Australia's major banks are mounting a rearguard action in response to the interim report of the Financial System Inquiry last month. But smaller institutions say the playing field remains heavily skewed in favour of the Big Four and needs to change. In a moment, I'll speak with the chairman of the inquiry, David Murray. But first, this report from Neil Woolridge.
It might not have the steamy revelations of the Trade Union Royal Commission, but David Murray's Financial System Inquiry is still ruffling some feathers.
This is not the time for complacency. We need to make sure that we use this opportunity, this fantastic opportunity that the Financial System Inquiry represents, and we use it for real reform and real change.
The key issue for regional banks and mutuals is levelling the playing field.
The unfair advantage of the Big Four banks needs addressing.
They estimate the Big Four get a taxpayer subsidy of up to $4.5 billion a year through their protected status as too big to fail.
In any country where you have that kind of unpriced guarantee, what that means is it encourages banks to take risk and not worry about failure, which also means that they can attract funding at a much lower rate.
But the major banks have been doing some calculations of their own and say the Murray inquiry underestimates how well capitalised they are. However, the organisation representing mutuals and building societies says domestic systemically important banks, or DSIBs, need to pay more for their privileged position.
There can be no disputing that Australia, as it stands in terms of the DSIB capital surcharge, is certainly at the lower end, and we think that needs to be reviewed to make sure that we're getting the levels right.
Among the other key submissions revealed this week, ASIC has called for financial advisors to hold a university degree. Australian Super wants better disclosure of superannuation fees to allow customers to compare charges, and the Reserve Bank has warned against more competition in the mortgage market, saying home lending is already well supplied and any more could increase systemic risk. However, Deborah Ralston says while there's a need to encourage business lending, the price signals for banks must be appropriate.
If we start to give credit out at very low rates to lots of institutions, we're going to have failures, and that's not economically efficient.
Now it falls to David Murray's team to sort through the mountain of submissions and competing interests and report back to government in November.